So next up, we're going to talk about depreciation periods. So basis, we've got to determine what our basis is because we need to know how we're going to calculate our, what we're going to base our depreciation on, right? If our asset is worth has a basis of $100,000, we're going to have a different depreciation expense than if our asset had a basis of $50,000, right? So that's why it's important to determine what that basis is. Next up, though, are our depreciation periods, otherwise known as class life. So the IRS tells you what your asset class life is. You don't have to decide. The hardest part on this is just determining sometimes, okay, what kind of an asset is this? Is it equipment or is it office, piece of office equipment? Like what exactly is it? They have established these recovery classes for various types of assets. So we can divide assets into personal property as opposed to personal use, and real property. Real property essentially is just real estate. Buildings and land. That's real property. Personal property is everything else. So if it's not real property, it's personal property. Personal property includes things like equipment, furniture, and fixtures, anything that is not classified as real property. Real property consists of land and buildings, as well as any other structural components attached to land. Okay, so anything that's attached to those items as well. Personal properties have shorter useful lives, shorter class lives. Okay, so you're going to depreciate them over a shorter period of time. Makes sense, they don't last as long, right? But the IRS still tells you how long you can depreciate it over. It has a recovery period of 3, 5, or 7 years. Real property has a recovery life of either 27 and a half years or 39 years. Now, there are some other recovery classes or class periods of 10, 15, and 20 years. They could be within those 3 class lives. They could be personal property. They could be real property. So we kind of got this, if you were thinking of a Venn diagram. Let's see. I don't know if this is going to work, but these are separate. But we've got a little overlap here. These are 10, 15, 20, meaning it could be real property, it could be personal property. But these are our class lives. That's it. So 3 years, 5 years, 7 years, 10 years, 15 years, 20 years, 27 and a half, or 39 years. So those are the class periods. This is a short list showing you certain items that are within those class. Now, this is not exclusive by any means. But some examples, racehorses, they depreciate racehorses. So racehorse is an asset that gets depreciated over 3 years if they're less than 2 years old. And then certain specialized industry tools as well. We're not going to work with the 3-year asset class life. The ones that we're mainly going to work with are 5, 7, 27 and a half, and 39. Those are the ones that we're going to calculate. 5-year assets are automobiles and light trucks. By light trucks, we mean under 6,000 pounds. Computers and peripheral equipment, so printers, scanners, that kind of stuff, anything peripheral, monitors, that has a 5-year, those items have a 5-year period. 7-year, furniture, fixtures, and equipment, different from office equipment, or different from computer equipment. So equipment, think tractors, anything that is used to, manufacture something else, or to in that sort of process. So that rivet maker that I talked about, that's a piece of equipment. Furniture and fixtures, so that table that I was referring to, the light fixtures, that sort of thing. So those are 7-year. 10-year vessels, barges, tugs, and fruit or nut-bearing plants. Don't use that all that often. And again, some of these things are going to be used in certain geographical areas more frequently than others, right? So if you live in, you live near the Mississippi or something, you might see, and you're working at a CPA firm, you might see that more frequently, the vessels, barges, and tugs. If you're living in Florida, you might see the fruit-bearing plants more frequently. Again, these are all things that are used in a business. So if you happen to have an orange tree on your personal property, you're not going to be depreciating your personal orange tree. This is if you are using it, you are making money off of, you've got a business where you're producing oranges, that sort of thing. 15-year wastewater treatment plants, telephone distribution plants, hardly ever see that. What you do see in Iowa, though, are farm buildings. So those are 20-year properties we're talking, which makes sense. So they have a shorter class life than other types of buildings because they get a lot more, they're subject to a lot more abuse, right? They're around livestock and they're being used in different ways than some of these other buildings. But, so what am I trying to say? I'm not real versed on farms. So, but barns, that's the word I'm looking for. So barns, or anything where you're, type of building where you're keeping equipment. I know, isn't that terrible? I grew up in Iowa and I can't think of the word barn. Buildings where you're keeping equipment, sheds, that sort of thing, or where you're keeping animals and livestock, those would be included in farm buildings. Next up are residential real property. All right, so now we're getting into more buildings, but this is residential. So something where somebody lives in it. It could be a home, it could be an apartment building, it could be a condo. If somebody uses it for living quarters and then it's being rented out, then that would be a residential real property. 31.5-year property, we don't really even talk about that because this property, it was a special class life, but it was between 1987 and 1993. So if it was 1993 and now we're in 2025, we're getting pretty close to 31.5 years. So the earliest that it would have been, or the latest that one of these pieces of property would have been purchased is May 13th, 1993. And now that property is 32 years old, so it would be fully depreciated. So you're not even going to see this anymore, the 31.5 year. It just simply means the reason it's between those years is because the tax law changed. Something changed and it was grandfathered in. What we have now is 39-year property, non-residential property acquired after May 13th, 1993. So office buildings or any other type of, building that is used for business, but you're not living in it. Someone doesn't live in it, right? So, the Costco building that they have out by the interstate, or the gas station, that these are buildings that get depreciated over 39 years. Nobody lives in them, right? So those are the different asset class lives or depreciation periods. All you do is you figure out what it is and then look up the chart. Okay, where does it fit in this? And that's the length of time you depreciate it over. Okay. So you don't have to make any decisions as to how long you're going to depreciate it. And remember, there's no salvage value either, so we don't include that in the concept. Okay, this is the one that